All right, joining us now with her take is Lori Calvasina, RBC Capital Markets Managing Director and Head of U.S. Equity Strategy. Lori, do you think that this is a bubble for equities?
I do think the rally's gotten ahead of itself. I do expect choppy markets from here, but I don't know if I would quite use the word bubble yet. I would use the word fast forwarded. To me, the move we've seen off the March 23rd lows has been very textbook. It's just happened very, very quickly. The kind of things you would expect to see lead in a recession recovery trade have been leading. The magnitude of the move we've seen so far, frankly, in percentage terms, has been pretty close to what you see within a 6-month period off of a recession low. So I do agree that we're a bit ahead of fundamentals. I do agree that we're due for a breather, but I just don't know if I'm quite in that bubble camp yet.
Is it maybe that the markets are just moving so much faster than they used to, Lori? It's like I feel like the market priced in the entire economic rebound coming out of lockdown in about 3 weeks.
It did. And to be honest, it priced in the recession in basically the same amount of time. If you look at the peak in the market from February 19th down to the low on March 23rd, the percentage drop that we saw was exactly in line with the average peak to trough recession drop that we've seen in the market since the 1930s. It wasn't even extreme by historical standards. It just happened in a very compressed time frame. And I think we've gotten that initial rebound trade in the same kind of compressed time frame.
So what do we do now? I mean, if we think that the entire rebound is priced in or at least close to it, cash doesn't seem like a great option. Bonds have, well, they've been bonds and not giving you much money at all, negative on a real basis with inflation, Lori. Where do we put the money, even if our viewers agree with all that?
Yeah, so look, I'm an equity strategist. I always want you to put your money in equities, and I never want you to get out completely. What we're telling investors to do is keep a balance. So we want a balance of defense, cyclicality, and longer-term secular growth. On the defensive side, we like utilities. They didn't really hold up as well in the drawdown because tech stole their thunder. So you've got really nice valuations there, and you've got very safe dividend yields. That's one of the reasons equity investors ultimately like U.S. stocks. On the cyclical side, we like industrials. We think you've got just as cheap valuations as what you've got in financials. This economy is starting to show some initial signs of healing. And we think people are going to want to get back to work, even if they might temper how they have fun and engage on the consumer side of the economy. So we like industrials here. And secular growth, we like healthcare as our pick there. We're actually neutral, the tech TIMT space. But one thing we keep telling people is if we're kind of getting out of this initial rebound phase and we're looking at the new normal, what does that new normal look like? To echo some of the things Powell's been hinting at, we think things might be sluggish on the economic side for a while. We don't think we're back to a rip-roaring economy, and that favors secular growers.
Yeah, I mean, I think what we're going to start to see, Lori, is that companies are realizing that even if they come back to sort of quote normal, they're going to be able to do a lot more with a lot fewer workers, unfortunately. What about, as you call them, the hedge fund hot dogs? Looking at your recent research, you note that these hedge fund stocks that they all sort of pile into the same names, they have outperformed, maybe because they're all piling into the same names rather than them just being, quote, right. Should we just sort of scour what hedge funds do and follow them? Is that some kind of a strategy?
Well, it's been a great strategy over time to sort of follow the smart money. And to be honest, those hedge fund hot dogs, which are just the most popular stocks in hedge funds, we look at it every quarter based on filings. They're crowded into by long-only investors as well, retail investors. A lot of people like these stocks. ETFs have high holdings there. So it's not just the hedge funds that are crowded in. But, we have seen some rotation in the market since mid-May. And one of the things we've noticed is that those hedge fund hot dogs have really not been leading the pack since then. So, we always tell people, there's a lot of great names on those lists. Active management knows what it's doing. Frankly, I see that echoes of that in a lot of my work. But you do want to diversify. You do want to have some balance there because when we do think leadership can whipsaw here in this, sort of choppy next chapter that we see for the market.
Bottom lining this conversation, no bubble, but probably a little ahead of ourselves and be cautious. Probably not a lot of upside left.
Right. And I would say, look, I don't necessarily rule out the idea that we will have a bubble down the road, but to declare it now seems very, very premature to me. I think this has just moved in fast motion, so to speak. And I do think there are going to be some bumps in some of the economic data. We talk a lot about how this last leg was driven by positive economic surprises. If you look at the U.S. economic surprise indicator that Citi puts out, it's actually back to where it tends to peak out at. So if we lose that driver in the market, it could help us spark a pause here.